All right, hello and welcome to Camel Finance. I'm your boy Camel, and today I want to be giving you a quick cycles masterclass, a introduction to cycles, how they work, and therefore if you've been on the channel before, you've probably seen me use them. I know I often get a lot of questions saying, is there some way I could do a video to explain these and show you exactly how they work with all the rules? So that is what today's video is. I first of all have to acknowledge that I by no means claim to have invented this system or discovered this system. I think it's no secret that I got this from Bob Lucas. I often reference Bob and his charts in my YouTube videos. So I got this from Bob Lucas. I'm by no means claiming to have discovered it or invented it. And I believe, although don't quote me on this, that he got it from Charles Nenner. So Charles Nenner developed this cycle system, or a cycle system at least, that he used at one of the big four banks. I think it was Goldman, it might have been JP Morgan. But either way, if you want to go and take a deep dive and find out a bit more about these cycles afterwards, then you can look up Charles Nenner and of course Bob Lucas. So we're going to get into this. I'm going to go through all of the rules, all of the systems, everything you need to know for how these cycles work and how I use them in my trading strategy. I think it's important to point out right off the bat that this is just an edge, okay? It's not a holy grail. It's the same with any trading system. So do not be irresponsible as a trader or an investor. Do not spot a cycle low after you watch this video and go all in, or think, oh, there's a cycle low, 25x leverage. Okay, all the same rules apply. Making the money is relatively easy in trading. Keeping it is, however, the most difficult part. So just because you spot a cycle low after this, don't be going all in on any trades. Remember, you cannot afford as a trader to be taking 10-20% chunks out of your account if you have to suffer a stop loss. A stop loss should be sized so that even if you get stopped out, it does not harm you. It does not take a chunk out of your account. And this is the number one thing that most traders get wrong. So be sure to always size your trades appropriately. Make sure you're not taking large chunks out of your account. The key to trading and to being able to do this successfully is to always keep the stops small. Always make sure when you're wrong in a small way, and when you're right in a big way. So don't be looking at these cycles and saying, okay, 25x leverage, all in. Okay, don't be doing that. Be responsible. Remember, you're against yourself ultimately. Everyone likes to think they're against the market. Everyone likes to think they're against other traders and against Wall Street. But in trading, you must master yourself. You must make sure your stops are kept to a small size, 1 to 2% of your overall account, and that keeps you in the game. Once you've been kept in the game long enough, you will notice that you are finally the trader you have always dreamt of being. So the first thing I want to point out is for Bitcoin and the S&P 500, which is the cycles that I tend to use the most. I don't tend to apply cycles to a bunch of other asset classes, although they do exist in many other asset classes. But for Bitcoin and the S&P, Bitcoin undergoes a 60-day cycle, the S&P a 40-day cycle. There is a tolerance of 10%, which gives us obviously 6 and 4 days respectively. Therefore, the range for a daily cycle for Bitcoin measured low to low is 54 to 66 days and 36 to 44 days for the S&P 500. Once we chain 3, 4, 5 daily cycles together, we get a weekly cycle, which is just the same thing, but on a weekly chart. And as you can see here, the weekly cycle range for Bitcoin is 24 to 28 and 22 to 26 weeks for the S&P 500. Take a screenshot of this, write it down, do whatever you got to do, memorize it. You'll need this if you're going to use this system for Bitcoin and the S&P 500. I need to make a quick note here that larger cycles exist outside of this. So like I said, we got 3, 4, 5 daily cycles that form a weekly cycle, and then multiple weekly cycles chained together do give us bigger cycles. So the best example of this that most people are probably aware of is Bitcoin's 4-year cycle, and the S&P 500 also undergoes a 4-year cycle as well. A fractalization does occur where we get these small daily cycles, chain a bunch of those together, and we get the weekly cycles, and chain a bunch of the weekly cycles together, and we do get larger cycles, bigger macro cycles existing. So I've got a little terms table here for you. I'm just going to quickly go through this, but ultimately I think this mostly is going to serve as like a key or a point of reference in case you need to at some point come back and see what these abbreviations mean. But we have a daily cycle low, which you'll see later as DCL. This is simply the lowest point in a daily cycle, and it serves as an anchor point for the daily cycles, which of course are measured low to low. A half cycle low, or HCL, shows up halfway through the daily cycle, and it could be above or below the daily cycle low. If it's above, that indicates the cycle is bullish, and if it is bearish, then we would expect the half cycle low to form below the daily cycle low. Again, if any of this seems confusing, just stick around. It will all become clear in just a moment. So the weekly cycle low, or WCL, is the lowest low within the weekly cycle. The weekly cycle is comprised of multiple daily cycles combined. As I said, usually 3 to 5 daily cycles will make up a weekly cycle. And then we have left translated and right translated. Again, I'm going to go into this in more detail in just a minute. If it's a left translated cycle, it just means the top for that daily cycle has come in at the left of the midpoint of the cycle. So if it's a 40-day cycle, low to low for the S&P, the midpoint is of course 20 days. If the top of that cycle comes in to the left-hand side, then we would call this a left translated cycle. And if the top was to come in past day 20 on a 40-day S&P 500 cycle, then we would refer to that cycle as right translated, simply meaning the cycle top has come in to the right-hand side of the midpoint of the daily cycle. So the cycle lows are measured low to low, and that is on a daily time frame. The cycle lows will form inside of their timing band 80% of the time, and of course 20% therefore will be forming outside of the timing band. The cycle lows work best in trending markets, but they can be used in any market. So I've knocked up a schematic for you here. As you can see, at the bottom we've got a weekly cycle and a daily cycle low just here where my cursor is. So a weekly cycle is made up of 1, 2, 3, 4 daily cycles, and that gives us the bigger weekly cycle, as I said. So you chain a few of these daily cycle lows together and we get a weekly cycle. You'll also notice in a bullish cycle, we form the weekly and the daily cycle low, we rally up into a half cycle low, then we get a high that drops into the daily cycle low, we go again, another daily cycle broken up by a half cycle low, another daily cycle broken by a half cycle low, and then typically what you would get in a weekly cycle is the first few cycles right translate, followed by the last cycle in the weekly cycle forming left translated, meaning the peak has come early, and then we spend the rest of the portion of the cycle in a decline into that weekly and daily cycle low before we could potentially go again. In a bearish cycle, we would typically see the weekly cycle low again. Note the weekly cycle low here and here. The weekly cycle low is again comprised of 1 daily cycle, 2, 3, 4 daily cycles making up the weekly cycle. When it's bearish, it means typically most of them are going to be left translated. Again, I'll show you this in more detail in just a minute, but you'll notice we rally up half cycle low, daily cycle low, again, another daily cycle low, but this time, notice how the peak comes before the half cycle low, before the midpoint. So this is left translated, and then that tells us that we're likely going to be declining. Again, another daily cycle, this time broken up with a half cycle low, and again, before we have a chance of coming out of the weekly cycle low and building another base or resolving to the upside. So the key take home here is that in a bullish cycle, surprise, surprise, we make higher highs and higher lows. If I go back one slide, you'll be able to see this. So in a bullish cycle, you'll notice all the daily cycle lows are higher and higher. The highs are also higher highs, and therefore we have an uptrend, versus in a bearish cycle where we have a succession of lower highs and lower lows on the way down. So the next thing you need to know is the cycle translation. So the translation, as I already kind of said, refers to the point at which the high of the cycle occurs. If the cycle high comes to the left of the midpoint, it is termed left translated. And if the cycle high comes to the right of the midpoint, it's termed right translated. If the peak is perfectly timed in the middle, it's considered neutral or leaning towards a bullish cycle. So here I've got a little bit of the S&P 500 from a few years ago. You can see here, the green arrows denote the daily cycles, right? And from this low to this low was 38 days. From this low to this one, 36. From this low to this low, 40 days. And from this low to this low, 44 days. So what I've done is added a blue vertical line to show you the midpoint of every single one of these cycles. That's all these vertical lines show. And what you'll notice is we come out of the daily cycle low, the peak comes to the right hand side of the midpoint, meaning this is a right translated cycle. And then we find the daily cycle low and we go again. Notice again in this 36-day cycle, we get the peak forming on the right hand side of the middle of the cycle, the midpoint, and therefore this is another right translated cycle. Before finding that daily cycle low again, this time we had a 40-day cycle low broken up perfectly by that half cycle low in the middle, and as you can see, the peak came to the right hand side of the midpoint, again another right translated cycle, and it's the same deal here, isn't it? A 44-day cycle this time, broken up by a half cycle low with a high on the right hand side of the midpoint, meaning this was another right translated daily cycle. So all the while we see highs come in on the right hand side, all the while we get right translated cycles, it tells us that the market is leaning bullish and we should be continuing to expect further upside until the market shows us something different. The inverse is of course true, and that's where left translated cycles come in. So you can see here, same deal, right? 36 days low to low, 36 days low to low, 42 there and a 42 there. Again, the blue vertical lines denote the midpoint of each of the cycles. So what you'll notice is right off the bat, we get a right translated cycle. The peak comes to the right hand side of the midpoint. Then we find a daily cycle low and we rally up. However, from this point on, you'll notice the cycle top comes into the left hand side of the midpoint. So this here is a left translated cycle. It's the same deal again, 42-day cycle here. The peak comes into the left hand side of the midpoint. So we have another left translated cycle, which tells us to be open to seeing further downside. And of course, that's what we get. The same is seen here between this last 42-day cycle, measured low to low. We get the peak show up on the left hand side of the midpoint. Another left translated cycle tells us to be open to seeing further downside. So the translation of the cycle is a big tell for the direction of the market. If we can continue to see peaks showing up on the right hand side of that midpoint, then we can continue to expect the higher highs and higher lows in an uptrend, versus if we start to see left translated cycles and cycle lows that come down and take out the prior cycle low, that tells us that we are likely going to enter a downtrend, and therefore there is a bearish implication to the cycles. So the next thing we need to know is how to identify and confirm the cycle lows. So I like to use a swing low pattern or a trend line break. You will have seen me do this if you've been on the channel before. You could also use a cross above the 10 moving average. I think that's what Bob Lucas likes to use. Or you can choose your own. Remember, there's a million ways to make $1 million. You can do whatever you want. It is important to make sure we have a cycle low confirmed, because sometimes cycles will extend significantly beyond the timing window. So you don't just want to be measuring 40 days for the S&P 500, finding a day 40 and going, yeah, okay, all in there, 25x leverage. You don't want to be doing that, okay? You always want to make sure you've got some kind of confirmation, a swing low, a trend line break, a moving average cross, something to give you some level of confidence that that was indeed a cycle low. Because occasionally, particularly in very bearish conditions, the cycle lows will extend significantly past their expected timing window. Cycle highs, I tend not to pay too much attention to. They're unreliable and inconsistent compared with the cycle lows. The cycle lows, you'll notice, are very, very consistent, versus cycle highs. Of course, they can form anywhere, whether it's left translated, mid, or right translated. So picking cycle highs is a lot harder to do. Things you can look for, however, are the opposite of the confirmation signals. So you could look for a swing high pattern, trendline breakdowns, crosses back below the 10 moving average. You can also use the timing band. So if we know we've had a 40-day cycle for the S&P 500 and we've got a straight up rally that goes all the way to day 35, day 36, then you could say, well, we're expecting a pullback into the daily cycle low, and hop out of your position based on the timing band and wait for the next daily cycle low to show up. Or of course, you can choose and develop your own thing, whichever suits you best. For me personally, I find it's typically best to allow the weekly cycle to largely unfold and look for a key loss of support or a technical breakdown. Again, if you've been on the channel before, you will have seen me do this. And so the last couple of things to point out here are cycle failures. A cycle failure occurs when the price breaks below the previous cycle low. So if we come down and find a daily cycle low and we rally up a little bit and then roll over and undercut that daily cycle low, that counts as a failed cycle. A failure of a cycle indicates bearish price action is to come and further downside is to be expected until at least the next daily cycle low shows up. Weekly and yearly cycle lows, these bigger cycles, typically end with a failure of a daily and weekly cycle low. So again, if I hop back to this part, you can see our weekly cycle comprised of 1, 2, 3, 4 daily cycles. You'll notice we get right translated daily cycle, a right translated daily cycle, a right translated daily cycle, then a left translated one that fails and undercuts the daily cycle low on its way back down to that weekly cycle. So this would be very, very typical to expect after 3 of these daily cycles, to expect a kind of a blow off top, a mini blow off top, and a cycle failure thereafter. So because of this, it's always important to zoom out and understand the context of the larger cycles. And the last thing to point out is occasionally bear traps will show up in the form of what's known as a cycle inversion. So an inversion will force the half cycle low into becoming a daily cycle low. And usually this comes after intense flushing of price at the end of a weekly cycle. Inversions indicate seller exhaustion and trend reversal. Of course, if we exhaust all the sellers into that half cycle low and then that becomes a forced daily cycle low, then it speaks to all the sellers being done, a capitulative move to the half cycle low, and we then have to try to catch the reversal out of that half cycle low. They're very, very rare, and I've put here they're difficult to spot because one tends to be waiting for the daily cycle low. And of course, if we only get to the half cycle low, the expectation will be, well, we're only halfway there, there's probably more to come. So it's very important to pay attention to trendline breaks or swing lows or 10 MA crosses, whatever you're going to use. It's important to follow price, because if the market does make one of these inversions and quickly reverse, you want to be able to capitalize on it. And that's why it's always important to have something like a trend line break as your line in the sand, where you say, okay, if we break out of here, then something different is going on. These are very rare, but inversions do show up from time to time. And so with all that said, that's pretty much it. There honestly isn't a great deal more to talk about. It's quite a simple system. Like I said, you might have to go back and just make a note of the rules. You will need to know the number of days and the timing windows. But the best way to understand this is to practice it on a paper trading system, or go back and just add the cycle lows in and count the days. You'll notice I've been doing this for a long time. We get the daily cycle lows, we measure it out 42-ish days. Here's another one at 45 days. Here's another one here at 38 days or 37 days. There's another one there, 36-ish. And we're now expecting to see another one show up any day now, because we are getting into that timing window of 36 to 44 days. So we should be about to find another one, as I've been talking about. It really is as simple as that. You can see here, I've got my trend line. This is my line in the sand. If we can form a swing low pattern, then we can potentially buy there. And if we can break out this downward sloping red resistance line, then we can say with confidence, it's time to get long. Like I said at the start, it's important to manage the risk. It's important not to go all in on one of these trades. It's important to be responsible at all times. But I think what you'll find is these cycles are very reliable for the S&P and for Bitcoin. They also do give you a nice edge, a nice area to manage risk around. For example, if we get a swing low out of here and a trend line break, then wherever that low forms, we mark that as the daily cycle, and that becomes the line in the sand. We do not want to see cycle failure out of here, because if we do, then we know that will tell us that we are going to be trending down into the next 40-day cycle, and therefore we should expect bearish price action going forward. These blue arrows denote the weekly cycles. So you can see we've got 1, 2, 3 daily cycles into that weekly cycle, looking for 1, 2, 3 more daily cycles into the next weekly cycle. So that is it. That is all the rules. It really is quite a simple system. You just have to apply practicing it a little bit. Like I said, you'll need to know these. You'll need to know the days and the timing windows. Remember, the cycles are measured low to low and will form inside of that timing window 80% of the time. If we're looking to the long side, then we want to see higher highs and higher lows split up by these half cycle lows. And we know that after we've seen 1, 2, 3, maybe 4 daily cycles, it's time to start expecting a left translated cycle and a decline into a weekly cycle low. If you're bearish biased, then you are looking for all of your cycles to left translate, meaning they top before the midpoint, as I said, and then roll over, and expecting new lows all the way down into that weekly cycle low. As I showed here, and as you probably have seen before if you've been on the channel, these cycles are very consistent. So again, so long as you can manage your risk, so long as you can control your stop size, so long as you can draw a trend line break or look for a swing low pattern to show up, then you have a nice area to manage the risk around, and all you can do is respect the cycle and see what the market will give. Like I also said already, cycle failure is a thing to look out for. When we are in a chart like this, for example, we do not want to see a cycle low show up here, for example, break out and then roll over and take out wherever that cycle low forms. That will be a failed cycle. It tells us that more downside is coming, and we will therefore have to be dealing with further downside price action, at least into the next daily cycle and possibly beyond that. Given where we are in the weekly cycle, which you can see from here, we got this weekly cycle low, we should be expecting to see, hopefully, that right translated cycle pattern show up like this. Now, of course, if instead what happens out of this current weekly cycle low is we get a quick move up that then starts to have multiple cycles that fail one after the other, then that will tell us that the top is probably in, and we have a significant number of daily cycles ahead into that next weekly cycle decline, possibly going to enter a big downtrend. So the cycles give us a very nice context. They give us a contextual awareness. And as ever, the best way forward is to take it one day at a time and see what the market will give. So I hope you found that valuable. I hope you found that useful. It's quite a simple set of rules, and practice makes perfect, as with anything. Just remember, if you're going to practice, use a paper account, or at least ensure that you're trading responsibly. Let me know if you have any questions. And in the meantime, take care from me. All the best. Cheers. Bye.